Good evening and welcome you all for today's Friday webinar. So today's topic is wealth creation from sectoral trends. As we all know that, in the Indian market, stock market industry, the entire market cap, close to around 2.5 lakh crores plus of market cap, is actually been governed or maybe comprised by only 17 broad sectors. 17 broad sectors that comprises our Indian stock market, I should say. And if you break down the 17 broad sectors, it comes to around 184 industries as such. So, definitely as an investor, one would be finding it not very easy to identify the potential upside in the sectors and with the breakup of 184 industries as such. Also, the fact that the current times are very, very important to choose the right, sector with the assistance of the right asset manager. So, the government on one side is aspiring to cross 5 trillion mark GDP, and the GDP is estimated to grow at around 8% in FY23. So, these numbers are also equally supported by the growing public investments into various sectors and a good pickup in the private sector investments as well. The momentum is very, very attractive as of now. So while the macro question that always arises in all our minds is that which space is going to be attractive and where the end returns can be made. It's $1 billion question. So this the topic for today's webinar, wealth creation from sectoral trends. You all must have now realized as to how relevant this topic is for today's webinar with the background that I discussed. So to discuss and to give more insights about the topic, today we invite Mr. Amit Doshi, co-founder and investment director of CARE Portfolio Managers, to our webinar. Welcome, Amit.
Thank you, Mr. Umar.
Before I hand over the podium to Mr. Amit, I will just share you all his profile in brief. Mr. Amit Doshi is a director at CARE Portfolio Managers Private Limited for more than a decade. CARE PMS is a SEBI-registered portfolio manager and manages clients' fund by investing in Indian equity markets in the listed space. The clients, which includes individuals and NRIs. Amit's role at CARE PMS includes research and portfolio management. Previously, he was part of PricewaterhouseCoopers Private Limited and RSM & Co. for more than 9 years. He has contributed articles, his expert views to leading newspapers, newsletters, and has made few presentations on Indian equity markets as a speaker at various platforms. Amit Doshi is a chartered accountant and has cleared level 2 of Chartered Financial Analyst USA. So this is the profile of Amit. So as I discussed, the agenda has been set and made very clear. So the next 45 minutes, you're going to hear good inputs from Amit on the topic wealth creation from sectoral trends. Without taking much time, let me hand over the podium to Amit Doshi. Amit Doshi, is over to you.
Thank you, Mr. Umar. I'll just share my screen for the presentation. Yeah. So first of all, thank you, PMS Bazaar. Thank you, Mr. Umar, for the kind introduction. And as we discussed, the topic of today's presentation is nothing but creating wealth from sectoral trends. So first thing first, disclaimer. The companies that we have used as an example are only for education purpose. Please don't consider anything as a, so to say, any investment recommendation. And we as individuals or firm might have investments in those companies that are likely to be discussed in the foregoing session. Mr. Uma said that it's very important to select the sector when we invest, and I think he echoes the view of none other than Mr. Benjamin Graham, who wrote in the Intelligent Investors book that the art of successful investment lies first in the choice of those industries. First, you have to select those industries, and then you have to identify the most promising companies. So first, that is the something which even Benjamin Graham echoes, and clearly the sector identification which are going to grow in future becomes very important when you make any investments. And there are when everybody comes to equity market, and obviously that's for creation of wealth, but there are different approaches. So there is somebody who will do value investing, somebody will do growth investing, some will do contrarian investing, somebody invest based on special situations, and there are people who also invest on sectoral trend. So when you identify a particular sectoral trend and then you invest in that sector, then there is an equal opportunity to make wealth, and that wealth is quite big, as we will see in the foregoing slides. So the sectoral approach is important, because whenever even if we look at index, like Mr. Uma also just discussed about the market cap of the capital markets, or the so to say, the economic growth, to $5 trillion, etc. But at the end of the day, wherever index will perform, underperform, or will give returns, or will don't give returns, there will be always be some opportunity. There will be some doors which will be having some sort of an opportunity which can be opened up to create an idea of return generation or wealth creation, and that's something which this approach of sectoral trend investing will help with too. And so the next slide, I just have created this slide, which represents the sectoral performance of index versus various sectors. So if you see the last three bottom line, which is Nifty, mid cap, small cap. So these three index, their performance and the various performance of different sectors over a period of 2019, 20, 21, 22, last 4 years. So if you will note, this say for example, Nifty delivered 12%, mid cap, small cap had a very bad year in 2019, obviously, and they didn't create any return, etc. But even Nifty generated around 12%, but there were sectors which generated far higher than Nifty. For example, realty. The same if you go to 2020, of course, it was a COVID year. Pharma and IT clearly outperformed by a big margin. If you look at 21, there was defense, the metal rally, as we also created a separate pockets of opportunity. So if you identify, irrespective of the index performance, the companies where the sectors which is likely to do very well is something which you can identify, and you can always generate far higher return than even the index, as it is depicted in the slide. So that was just a broad introduction. Now coming to today's agenda of what we are going to see for next 30-45 minutes. So key takeaways, as it is learning from the past. We will look at sectoral trends that has happened in the past. How did it go well? What kind of wealth did it create? What were the triggers? What impact did it have on the sector, etc. The second part will be triggers for sectoral trends. So so how to identify those triggers, where you can identify those sectoral trends and you can also invest. The third part is, yes, once you have identified the sector, how do you participate it? How do you really invest money in that particular sector? And the fourth, which is the outlook. So going forward, from now on, which sectors are depicting some sort of a positive trend or having positive outlook, which one can invest money today to create wealth for the next 3 to 5 years. So that's going to be the broad agenda for this presentation today. And with that, I'll move on to the first one, as it says, learning from the past. And whenever there is a history, there is a famous quote of Mr. Buffett, is that what we learn from history is that people don't learn from history. And I think it's really very critical because we must go through the history, have that data, have the analysis, and there is some sort of a trail triggers, some features which we are going to identify, and that's why it's very important to first go through the historical trends that we have seen in the past. While many say that equity markets is for future, past is forgotten, but there are still trails which you can, there are characteristics which you can figure out from the sectoral trends in the past. So let me first take the trend of pharma sector that happened around 2012 to 2016, and so we'll discuss about the pharma sector in the further upcoming slide. So first, to start with the pharmaceutical sector, let's first identify the triggers. Like, what were the triggers, or what are the things that kind of triggered the rally in the pharmaceutical sector during the phase of 2012 to 2016, and what were the key points? So the first and the foremost point was GDUFA by US FDA. So that's GDUFA is nothing but Generic Drug User Fee Amendment. So US FDA, as we all know, US Food and Drug Authority, which introduced GDUFA. The sole objective of introducing Generic Drug User Fee Amendment is nothing but to ensure that large public have access to the cheaper, so more generic drug access, and it should be accessible to all of them. So that was the core objective by which, with the intention with which the GDUFA was announced. And the role of US FDA, as we all know, is approve a lot of new application, give relevant permissions to the pharmaceutical companies to launch their drugs in the US market. And if you know, historically, pharmaceutical rally primarily has been driven by has been more of an export driven, and of course US being the largest market, that has been a focus of many pharmaceutical companies. Even today, I think the biggest or the largest one has been in that space. So that was the first start. So there was an intention of the US government to do it, and there was significant uptick in the ANDA approval rates. ANDA is nothing but this new drug application, which approval rates significantly jumped. It was around 40 approvals per month, which jumped to almost 65 approvals per month during that phase of 2012 to 2016. The review time, it used to take on an average 26 months to review application, which reduced to 14 months. So there was a significant reduction even in the ANDA review time by the authorities. Second, during that phase, the market share of US generic shifted from 72% to 90%, and that was the core agenda or core objective of the US FDA while introducing GDUFA. The third trigger was, now these were the two factors that were taken, or the the objective of the US government. Now Indian players who were very proactive or who were very keen to bag onto this opportunity of US generics, that significantly changed the fortune of the pharmaceutical sector going forward. So in 2011, around 17% of the total new generic launches, with the first and second entrant were Indian companies, which jumped straight away to 28% in 2015-16. So there was a significant uptick by the Indian companies who were focusing on the US market, and that really jumped their share of becoming the first or the second entrant in the US market. Indian companies, their launch time also, from the time they get an approval to the time the generic drug gets actually launched in the market, used to be 10 to 12 months in the previous, before the 2012, it reduced to less than 8 months post the period. So that's again a step which was taken by the Indian companies. And there was a lot of almost $70 billion plus, there was drugs which were patented, were going off patent during the same period. So as we said that, there was a large opportunity which was there, government triggered it, government wanted the generic share to go up, and Indian companies backed that opportunity of such a huge, the drug which were going to go off patent. And during the same period, the US generic market, as I said, the market share of generics jumped from 72 to 90. The same way, the size also jumped from $47 billion to $76 billion. So that's like almost a double. So that's a very huge jump in the market. So that was the core. So the key trigger was obviously the action by the US FDA, and then rest all followed with a lot of Indian companies bagging that opportunity. So these were the key triggers of the pharmaceutical sector. If you can identify the triggers, so you know there is something which is happening in the pharmaceutical sector, and the companies which are going to take advantage of this opportunity will significantly take an advantage of it. Coming to impact, so what sort of things that happened during that period? So as I said, a lot of companies, Indian, these are the top 6 companies of pharma who actually spend huge money on R&D during that phase. Their R&D CAGR jumped to, on an average, jump to 33%. They continuously spend 33% every year in order to ensure that they keep on generating and keep on launching this generic business from the United States. Their sale contribution, which was average 28% in FY11, jumped to 40% in FY15. So clearly they wanted to back the opportunity, and they did, in most of the cases. And obviously the revenue CAGR was significantly up, average of 26%, and average operating profit jumped by 28% of CAGR. And all these companies, because obviously they took those steps, they increased their US contribution, they jumped their top line, bottom line, and the companies were re-rated from significantly to average PE multiple of 22 to 35. And during the same phase, one will note that there are FIIs which are buying stocks of these companies which are doing well. So their share of 18% jumped to 28% during the same period. So this was the impact of that announcement by US FDA and the companies that were there. Now coming to our important part, which is the return or the wealth creation. So we have taken this Nifty Pharma performance during that same phase and compared to the Nifty. So while the sector in 2012 did 9% negative, they delivered 11% positive. You can see the same trend across 13, 14, and 15. So clearly that sectoral trend is visible from this chart. And if you look at the particular companies, that 6 companies that we discussed. So this chart depicts the kind of returns that were generated during this period of 4 to 5 years. And if I were to take a pharma universe, we have selected those 60 companies in pharma with a market cap of 300 crore and above. Then there were 5 companies which generated almost 10x returns. There were 9 companies which generated return in the range of 5 to 10 times, and 30 companies in the range of 2 to 5 times. So except this, around 19 companies out of 60 companies. So almost 80% of the company made at least minimum 2x and plus returns during that phase. So if you can identify those sectoral trend, those triggers, and you participate, there is a huge wealth opportunity to be made in that segment. Coming to the second, specialty chemicals. So after this 2011, 12 to 16, in 2016 the specialty chemical trend was started. Now let's see what were the key triggers for the specialty chemical sector. First and foremost, China, obviously we all know, grew by leaps and bounds, after 2008-9 significantly, and they made heavy, production, manufacturing without concerning environmental norms, etc. But in 2015-16, they became conscious, and a lot of environmental norms were stringently followed. And because of that, there was a huge impact on the Chinese chemical sector. 40% of the capacity had to shut down, 1,000 units were relocated, 80,000 units were fined, and there was a significant disruption in the Chinese chemical market. Second, during the same phase, US, China were in the trade war, and the Chinese export, 15% of Chinese exports, US had, so US share of Chinese exports were almost 15%. So that was a huge sum that again got impacted, in pursuant to which China could sell to the US during that time. During the same phase, there was significant growth, so there was a strong increase of labor and power cost as well. And with these environmental strong norms, the compliance cost also became very high, and that also added to the burden. So the Chinese were otherwise extremely competitive, started becoming less and less competitive in the global market. Now during the same period, India had a very decent, I would say, environmental norms, and a lot of companies invested heavily in the zero liquid discharge system, and a lot of companies, top-notch companies, invested heavily. So they were very much environmental compliant, and they were the one who could easily bag onto this opportunity which created out of this environmental disruption in the Chinese chemical market. During the same phase, what happened is, if you keep on reading the annual reports of all the chemical companies, or especially the specialty chemical companies, there is a clear-cut narration by the management that there was a shift of cost arbitrage sourcing model to knowledge arbitrage based strategic partnership. So while so far the global players were looking at sourcing the required chemical from either the China or the Indian market, but they wanted now to more knowledge-based arbitrage and to have into strategic partnership. So India was and started spending a lot of money on R&D during that phase, and they could enter into strategic partnership with a lot of foreign global companies. And there was anyways a very strong demand in growth in end user industry. So wherever this chemical sector was used, there was an extremely strong demand, and that was again a reason for specialty chemical sector to have a trend which was a clear cut and upward one. So these were the key triggers which clearly signified that there is something happening in the specialty chemical basket or sector, and there is an opportunity. Now, if you look at again the list of companies, you will see a lot of companies are into specialty chemical, and they invested versus the amount they invested in the next 5 years were far higher. So they clearly saw this trend coming, and they invested heavily, and you can see the results in the form of strong CAGR growth of 16% and strong EBITDA growth of 21%. And all the companies which were in the valued in the sense 16%, 15-16 average multiple were significantly jumped to 23 times their earnings. I have also, while I have mentioned 2016 to 2022, that 2022 P's are not the correct reflective figures, because last year there was a huge jump in the input cost, and the profitability figures were not, so to say, correct to say. So I have just taken a period pre-COVID, so just to reflect the PE re-rating that did happen during the same phase. And yes, returns, same way, this orange bar represents the chemical sector performance versus mid and small cap performance. So while individually, you might see there were some blips where chemical sector didn't perform as high as say a small cap or the mid cap index, but on an average, if you look at the 5 or a 6 year trend, they delivered far higher and generated heavy CAGR for all those who invested in the specialty chemical sector. And coming to this, specific 6 companies which we discussed, Aarti, Alkyl, Atul, Balaji Mine, Deepak Nitrite, Marine Flora, and PI Industries, they kind of generated significantly heavy returns. While again this chart is slightly, so to say, distorted, but while it is showing that there is a very heavy return on the 20 to 22 phase, but even if one were to look at focused on this period, it has from 0 to 500 has also happened during the same phase. So it is equally, but this because of this heavy sharp price rise during that phase, the number is not looking that great. But if you look at this table, again the same sort of we put a criteria of sales of more than 300 crore, and the number of companies that generated 2x, 5x, and 10x returns were more than 40 in that basket. So there is a significant CAGR growth that did happen during FY16 to FY22 in the specialty chemical space. So that ends us with that specialty chemical trend. Now taking the third and the last trend of sugar sector. So while I said that 2022 that the chemical sector, I've just not yet ended. You never know, that trend still continues with this China plus one further getting into the space. Now sugar sector. So sugar sector, I think has been quite hot in last few years, and the heavy discussions with a lot of push from the government side. So we'll discuss on the sugar sector. What were the key triggers? Now, of course, it all started with overproduction of sugar, and the very high cost of production was there, and all the sugar mills were not making money; they were into losses. So that was the time when a lot of companies got debt trapped, working capital got heavily black, they heavily blocked. They could not make profits. They had to, so to say, delay or farmers' payments for sugar cane, and that's where government entered into this place. They realized that there is this problem and we need to resolve it. And while there was always so they introduced MSP for sugar, while sugarcane was always under MSP for farmer, but for companies it was not the case. But they did it for the sugar. So companies were otherwise were making losses were they also had an MSP, so they could make money and they in turn can pay to the farmer. So that went quite well for the sugar industry with the introduction of MSP. The export subsidy, because there was a huge oversupply of the production of the sugar during 2017-18, so it had to kind of release this excess inventory, and pursuant to taking the step of government of introducing export subsidy, they reduced the so they could reduce the excess inventory, so working capital can be free from the company, the inventory will move out, so that amount will get free, and the prices would be improving in trend because the supply will be restricted. And the fourth trigger is ethanol blending. So there was a serious implementation. So ethanol blending was always a program, but it never got seriously implemented. But during this stage, it got seriously implemented, and we all know that we were around 1.5 to 2% of ethanol blending, which was there, is now almost 10% plus, and the target of the government is to make it to 20% in next 3 to 5 years. With this ethanol blending program, what happened is it gave a lot of consistency or a lot of financial consistency to the sugar mills, because ethanol changed the revenue profit mix, the cyclicality, that typical sugar season, production season, and procurement season, kind of changed, and they could on a quarterly basis, the consistency came in on the numbers, and the profitability of the ethanol was equally there, because the ethanol prices were linked to the sugar cane prices. So any rise in the MSP of sugar cane were passed on to the ethanol producers as well, and that could easily be translated into better profits and more profits. And firm sugar prices. So the sugar prices remained firm for last few years. There were two reasons primarily. Of course, global, there was a deficit of supply. Brazil, who is the first and largest player producer of sugar, there was a weather issues, and pursuant to which there was a short of production. And at the same time, in last 2 years, last 1.5 years or so, the crude prices significantly improved. So they diverted their sugar to the ethanol, and therefore the sugar prices were quite strong during last few years. So that was one of the reasons on the global side. On the local side, again, as we discussed, there was an export subsidy which was provided, and therefore the money, the sugar went outside the India market. So to that extent, the availability was low. And secondly, this ethanol blending program, where the sugar was diverted to for the production of ethanol, which again was a reason attributable to the firm sugar prices. Now coming to that fundamental changes that happened for the sugar companies, like we spoke. So the ethanol revenue, which was, say for example 7.5% for Balrampur Chini, jumped to 21%. The ethanol EBIT, the profitability of 330 crores jumped to 1,000 crores in that 4 years. The loan, because the inventory reduced, the working capital or the short-term loans also reduced during this phase, and which brought a lot of profitability, cash flow generation, reduction of debt, and all bringing in this consistency, brought the valuation of single digit to all the sugar companies to double digit, which we got also. And again, going forward also, while so far they have approximately, capacity of ethanol is around 6,500 KLPD, is again likely to double itself in next few years, which is also the proposed expansion plan to make this ethanol blending program of 10% to 20%. So this again is a fundamental changes that's happening and likely to be the sectoral trend probably even for a few years. Coming to returns in the sugar sector, of course, as I said, 18 was a year where they make huge sugar and there was a losses, etc. But post which I think they significantly recovered. The orange bar represents the sugar sector and mid and small cap, yellow and green, and can see that they have clearly outperformed as a sector compared to the indices returns. And coming to few specific companies which we took an example on the financial space is that they made really huge money in this phase of 18 to 22. And again, if you look at the basket, the companies which took advantage or company who had stronger balance sheet to make expansion of so to say ethanol capex, etc., they could really cover it up. They could generate profits. They could have clear their inventory, and they made huge returns. So that's something, again, almost 18 companies in the basket created minimum 2x return to approximately 10x returns during this 4-year phase. So that's again a wealth creation opportunity. So with that, I end my first part, which is the learning from the past. So we saw 3 trends of pharma, chemical, and sugar sector, which allows us to see that how a sectoral trend can be if somebody had invested and what kind of returns that can be really made in that space if you invested in sector during that time. Now the second part, which is identification of triggers. So how do you identify these triggers, etc., the triggers which I discussed in all the 3 slides, etc. So I think here one has to clearly keep eyes open, eyes and ears open, as we call it, and you have to keep broader things in mind, like geopolitical happenings, world economy. I mean, we all know this US-China trade war. Trump focused too much on the Make in America program. Geopolitical happenings like this China plus one that is happening right now, or say this Russia-Ukraine war that is happening. So what kind of impact this geopolitical happenings and world economy will have on the businesses or the sectors that we have under our, so to say, radar, and that would make some things you will find out some triggers from there which could impact particular sectors. And the key point is government policy is what I strongly believe. Because if you will see earlier, so sugar, chemical, or the pharmaceutical, where government policies did play a significant strong role in pushing up any particular policy. So, for example, government to take steps like global steps, like say trade, they impose any trade barriers or they sign trade pacts for favorable countries for particular sectors. There are talks about textile sector, there are talks about chemical sector, pharma sector with Australia, with UK. So such global steps one has to see, and also have to see ground reality on how things are happening. And local steps like this PLI scheme or Make in India or Atmanirbhar Bharat, etc. So with in what direction government focus is, and those steps will allow us to identify things that are happening at the sectoral level, and there could be change of fortune of few sectors which government wants to do well in future. And on the second side, we also have to track macro data like monetary policies, inflation rates, this weather condition which will impact agri-commodity space, exchange rate which will impact the international trades, employment data. Different industries have the employment data. So if you see a lot of employment happening in a particular industry, you'll see that some things or some triggers are happening in that particular industry. And commodity price trends, so like we saw last year around metal rally that everybody saw, crude oil prices, how it is going to impact petrochemical sector, etc. So those are the things that one will have to keep in mind to identify or pick up those first triggers that would happen. The second would be the classification of triggers, because these trends have definitely, there are some trends which are long term or say structural in nature, and there are some which are short term and temporary. So these factors like these trade pacts or trade barriers, etc., they are more of a structural in nature. They are likely to be 3 to 5 years or even maybe more to that extent favorable for that particular sector. Government policy like ethanol blending program or this US pharma, what we discussed about, government wanted the generic medicine market to significantly improve and ensure that each public has access to the cheap public drug. So that wouldn't have been possible without action by the government. And change in global factors like China plus one, post-COVID, everybody realized the importance of having multiple vendors, so that we don't get our supply chain doesn't break. So these are something which are structural in nature. and zero carbon emission. Everybody is talking about making the world more cooler as compared to what it is now. So these are the trends which governments are focusing across globe and which are structural in nature. So everyone knows that they have to make things happen by imposition of these policies. And there are some which are short term or temporary in nature, like monetary policy. We enjoyed last 1.5 to 2 years of easy liquidity policy where no interest rate were falling, and few sectors like discretionary spend or equity market got boom. Inflation, which will impact the purchasing power of again, and it will again impact the discretionary spend. The commodity prices would have good fortune for the say agriculture sector or say for metal or mining sector, but at the same time it will be negative for the FMCG and the capital goods industry. And there are some points like this bottoming out or bounce back of the industry. So during the COVID period, we all knew at some point in time that the business of hotel or this entertainment, leisure, travel has clearly bottomed out because there was no action for 2 to 3 months, and so we all know that it's going to be a bounce back. It had bottomed out somewhere, and there would be a huge opportunity there. But these are more of a short term in nature. So it fell down for 3 6 months and then bounced back in the 1 year or so. So these are short term trends and long term trends. So one will have to take a call at the time of entering that this is more of a short term trade, and we have to focus on these triggers. Whenever they reverses, the short term nature will get reversed and the benefits will for that sector will expire soon. Now, with this, of course, while we have identified sector or the triggers, short term or long term or which sector has done, now let's go how to participate, because whether we go gung ho at one point, how do you identify different companies in the same sector, etc., is something which we'll discuss in the next part or the third part, as I said. So first, macro factors. So once you've identified sector, you look for the industry size, like what is the size or the scale, or how big is the industry, or what is the scale of this industry, which is where the impact could be. Because it allows some big will take some time, small industry could have a spurt very quickly, etc. Growth rate, what is that industry size likely to be after that triggers which you have identified is likely to be played. For example, we discuss about sugar, so this ethanol thing of 10% or 20%, how big that market would be and at what rate the sugar mills or sugar companies will likely to grow in the 3 to 5 years. Demand supply scenario, where do we have the capacity, what is the installed capacity of the industry, what is the demand likely to be, and will the industry be able to, so to say, cater to those new demand that is likely to be there, new capacity to be set up, how quickly those capacities can be set up, whether it will take 18 to 24 months or things can be set up in 3 to 6 months, etc. And last point is raw material availability, because if sugarcane is not there, for example, how the ethanol would be kind of created. So these are the key. First, once you identify the sector, these are the key points that you have to look at for the macro factors to look at before identifying the company. Now, moving on to the next part, which is the more of a micro factors, where you identify these and you believe that there is a huge possibility of this sector can really do well. And you form, of course, the list of companies which are there in that sector. What is the size? What is their size of their market share? Does it have financial sufficient enough to, so to say, take up the burden of the new capex and comply with the growth rates that industry is likely to participate going forward? And management, because management is one of the very critical factor. If somebody who is proactive, who is willing to take charge and to back this opportunity, like we discussed in the pharmaceutical space, the companies which were US focused did incur capex, did spend on R&D, and ensure that they could capitalize on the opportunity which US government did offer to the players. And last is valuation, like if all factors are fine, at what rate or at what price I'm getting in and whether I'll be able to make money. Well, most likely than not, if you have identified the trigger at the early stage, you're going to get at a nice valuation and as a huge possibility to make money for yourself. So of course, I think last 3-4 slides were a lot of, so to say, theory let's take one example to drive this point of identifying the sector, identifying the triggers, and then taking these macro and micro factors in place to identify this. So I'm taking one small paper sector, although it's not a very big sector, so to say. It doesn't even have space in say Nifty or a particular index, but it's sufficient enough because there are a lot of players, listed players in this space, and how they did during that phase we'll see in the upcoming slide. So what were the triggers for the paper sector, like we discussed for earlier, for the paper sector? Now 2018 was a year when there was a huge imports that were coming from Thailand, Vietnam, and other countries, which were very cheap compared to even the domestic companies what they used to produce the papers, because they're in the globally other than India, they have this forestation policy where the forest etc. are kind of created and maintained by those companies because it's their raw material. While India there is no such policy, so they have this pulp which either they import or they source, but it is quite expensive for the Indian companies. So the cost of production of paper is quite high for Indian manufacturers compared to what it is there in the globe. So they used to dump, and then they made a representation to the government about having the anti-dumping duty. So this was one of the trigger points that okay, now this anti-dumping duty is there, so domestic production is, so to say, protected to that extent. The second was ban on single-use plastic. We all know environment has become a big role, and now they are in 2020. They one fine day they said that we'll close all the plastic items, etc. But they couldn't really, so to say, implement. Now in 2022 they have implemented phase wise. So that's again a second trigger that the paper sector is likely to do well in the going forward period. Third, China factor. In Jan 2021, they banned waste paper imports, again owing to the environmental concern. So waste paper, they stopped importing waste paper. So the normal paper or the pulp which is used to produce the fresh paper or virgin board, as the virgin paper or virgin board, the prices of it shot up very high, and that kept the global pulp prices as well as the paper prices quite high in that phase. So that's something which was again another trigger for good price, good profitability in the paper sector. COVID factor, fourth. So COVID factor, after COVID, everybody, a lot of demand came from the packaging side. And so while we all know paper as in writing and printing paper, there is a huge demand on the packaging side. In fact, globally, it is almost 57% of the paper industry is on the packaging side and not on the writing, printing and the copier paper. So post-COVID, there was a huge surge in packaging demand, and hence the demand of paper was very strong during that phase. Geopolitical issues. So currently, what's going on? Russia, Ukraine, in Europe, this power crisis. Overall there is a huge inflationary commodity prices. So that has actually significantly risen the input cost globally, and supply crunch because some big plants in Europe, etc., got shut because of power crisis, and therefore again there was shortage in global supply of paper, and the prices remained very strong, which again allowed the paper companies, which will again allow paper companies to do well moving forward. But again, here the catch is that somebody will have to have an integrated player, because the raw material backward integration is very critical in order to take advantage of these factors. And the last is BI standard. So government recently has also introduced BI standard, which is mandatory now to have registration, minimum quality standards pursuant to which you will be allowed to import the paper. So that's something which was to this. So these factors put together clearly indicates that there is some a strong, so to say, play in the paper sector, which will allow them to grow very well. Now, second, we identify the industry. So global industry in total India and total world, India is the only largest commodity or largest economy which is growing paper market significantly high. Our per capita consumption is just 14 kg. In fact, few years back I was reading an annual report. It was just 8 kg. Now it has jumped to 14 kgs, and the highest is of course 300 kgs, as you can see on the chart. So with with 18% of global population, we are just consuming 4.2% of global consumption, and India is still the 5th largest consumer. So this will give you a judgment about what the paper industry globally is and what is India's share in that. And India primarily, it's almost 85% is a very unorganized segment, which is very so to say small people mills across country, and they are not very organized in fashion. And there are few players who are indeed, and the estimation is that this by 2027 they are likely to grow to 23 million ton from currently around 18 to 19 million ton, which it has as of now. So there is likelihood that it is going to grow well going forward. Now coming to the basket of the companies, you identify number of companies in the space. You see which kind of sub-segment they are present into, whether it is writing, printing, packaging board. There are tissue, craft paper, specialty packaged paper, etc. Also there. But for the sake of top players, I have just considered these two big segments, which are the largest. The packaging board is largest growing segment. Where is their regional presence? Are they backward integrated? What's the capacity size, their market share, which is significant importance in the commodity type space, and what has been their average margin for last 5 years. So you can identify the good players out of this, and you can accordingly invest in that. So that's how you participate in this segment. And now, so that ends the how to participate slide. Now, how Care PMS in this period or last few years we have played various sector. So just a small one slide or chart on that. And so like paper packaging, we believe was a very strong play, and we did have heavy exposure in 2019, which then we reduced, and post COVID we again increased in this space. Pharma again. It's not a pharma trend I'm talking about in 2012 to 16. This is something which is pre-COVID or kind of a COVID rally which happened in the pharma space. So we increased that during COVID period, and then again now reduced our sectoral exposure of pharma. As we all know, metal mining had a significant jump in last 1.5 years, and we did participate through metal and mining business as well. And sugar 18 to 22, which we spoke, we increased our share, and then now we again reduced our share to that exposure. So that's how Care PMS during various time have played during through sectoral trends as well. Now last part, which is what are the sectors to look for in 2022. So going forward, what are the sectors which are more attractive? So first, let's take automobile sector. So I think we all know automobile sector went through quite a tough part through last 3 years, of course, excluding this portion. But yeah, there were a lot of disruption in the automobile sector, and now hopefully there is some sort of a tailwinds that's happening. So if you look at this part of last 6 to say 10 months or so, there clearly seems to be some bit of outperformance compared to Nifty. So there is a price action which also determines that there is some sort of a price action indicating sectoral tailwinds or increase in the interest by the various players in the market. And so just we'll quickly discuss the disruption in the auto sector. So, few years back, this commercial vehicle axle load norm were increased by 25%. So straight away, a demand of 2 to 3 year commercial vehicle kind of, so to say, wiped out in that one government policy which changed the axle load norms. Overall economy slowdown that happened because of GST demonetization and BFC crisis also acted as a disruption for the automobile sector. The BS6 norms, which had a very significant cost, almost 70,000 crore was overall invested by automobile sector to transition from BS4 to BS6, and it also increased the cost of vehicles, and a lot of consumers delayed their demand of buying vehicles. COVID effect, as we all know, there was a huge lockdown and no demand came through. Commodity price since last 1.5 years, there was a fuel cost as well as multiple commodity input cost, which kind of, so to say, increased the cost of owning a vehicle. So that again acted as a disruption. And last is chip issues. Semiconductor availability during the COVID period acted as a big disruptor for the automobile, and we all know it had a huge impact on availability of automobiles. And this just to indicate numbers, during last 17 to 22 5 years, whether it will take passenger vehicle, commercial vehicle, two-wheeler or three-wheeler. The units, domestic sales volume has hardly, is only deteriorated by a significant number, as we can see from this slide. So that was the impact of disruption. Now, looks like there are positive triggers for these auto sectors going forward. And what are those? Let's have a look at it. So festive season. So festive season, after 2 years, we are likely to have a good festive season, and all the automobile companies are having strong management commentary about growth on that segment. Credit availability, interest rate have significantly lowered. Of course, now they are likely to improve, but still it's lower, and they are likely to improve the accessibility of credit and likely to improve the demand of vehicles. Overall, new vehicles are being launched. We all know what was the response of Mahindra or Tata Motors, the new models that are launched, how quick bookings are, and what strong numbers they have. And yes, we know huge waiting period because of COVID disruption. There is a huge waiting period. So now, with a lot of issues resolving, hopefully this impact will turn into a positive impact and would reflect in the numbers of the automobile sector. And the commodity price, which was the negative trigger, now again with reducing import, now reducing commodity prices, and crude now peaked out and now probably settling at lower levels, will likely to act in favor of the automobile sector. And chip issues, now the availability is significantly high. All the management has guided that the availability is becoming more clearer and available, and this is likely to resolve the issue. So the headwinds have now become the tailwinds, and looks like going forward auto sector is likely to have a good time. So now, how do you play or how do you participate? Well, we believe automobile sector is slightly becoming more and more competitive with this new player, global player coming in. So probably auto ancillary, this is clearly a shadow play. It can also be played or invested to make the similar type of returns in this automobile advantage, because competition could be high. So it might be difficult to judge which company will do well. And auto ancillary is, there are reasons why we believe. So there is a huge outlay of almost 26,000 crore, one of the largest allocation for the PLI scheme of auto ancillary. So there is a strong push from government. There is overall resilience because, while OEM did not perform well, but auto ancillary still continued to do well. So there is a bit of a resilience in that sector. So that's more safer, so to say. There is replacement demand or exports because, as I said, OEM did have a bad time, but there was a secondary aftermarket opportunity and export opportunity which remained active for the auto ancillary companies. And EV disruptions, we know EV is now a structural shift that's likely to come. So we don't know again which company will behave differently and will catch up the EV space. But the auto anch space will likely to be independent of that. Of course, you have to identify which ancillary products, but again, that's something which is likely to be positive for the auto ancillary. And so the point which I said about the auto ancillary did well despite auto did not. So the same, if you look at the chart, while all the figures were down by 6 to 30% in the first slide, in this slide we can see that there is a growth of exports, aftermarket, and auto component sale on the aftermarket did very well, despite OEM did not do well. So that's the resilience which I was talking about in the auto ancillary. And the second sector, apart from auto, I'll just discuss quickly, is the defense sector. We believe there is a play in the defense sector, and what are the triggers according to us. So there is a strong participation, a strong push by the government for private sector participation. The government did mention in last 3 years that without private sector participation, we cannot become strong indigenous player in the defense segment. The DPEPP, which is nothing but Defense Production and Export Promotion Policy, have a extremely ambitious target of 1.7 lakh crore by 2025, which indicates approximately 15% this industry is likely to grow for next 3 to 5 years. The budget allocation, there was a significant, almost 11 to 12% increase in the budget for defense spending by government, and not only the spend on the outlay, but also the capex. They announced a capex of almost 1.5 lakh crore, which is again 10 to 12% higher compared to last year's. So there is an increased allocation by the government on that space. FDI participation, now government allowed 100% FDI. Of course, 74% automatic route, but more than 74% is the approval route that one has to follow. But yes, there is a permission to foreign players to come and set up manufacturing in India. And there's a lot of exports, focus on exports. So in 2014 to 22, the sales jumped almost 6 times. From 2,000 crores to 12,000 crores, and now by 2025 there is again a very ambitious target of having 36,500 crore of sales through exports in the defense space. And recently, as we all know, government also announced a import list which is negative. So there are some 300 plus items that are announced as something which will not be allowed to imported, and out of which 90 items are by December 22. So there is a lot of indigenization play which is likely to come in the going forward period. And because so far we are importing almost 60% of our total imports, so that's going to have a significant impact on our so to say Atmanirbharta in the defense space. And quickly, in the last 4 years, 5 years, what kind of returns did defense space made? Almost nothing except last 1 year, which significantly shows jump, and almost 50% outperformance from the Nifty performance. This is of Nifty India Defense Index, which we are comparing to see what kind of returns. So that brings an end to my presentation almost. Some few credits, of course, a lot of resources, company annual reports, presentation, broker reports, some websites which we used for sourcing data, magazine articles, etc. And for the creation of slide, a lot of these images and etc. are used from these websites, which has made it look what it is as of now. And with just our basic some idea about how do we create portfolios of what is the strategy of Care PMS. So around we have in one portfolio around 18 to 20 companies with around 8 to 10 sectors that we take exposure to. We do have limit on single sector or single company, like we don't invest more than 12% in a particular company or more than 20% in a particular sector, irrespective of how bullish we are on a particular sector. And we do, of course, regular review and balancing. I discussed in that slide. When we see that opportunity, we increase our stake and we reduce if we feel the opportunity has been captured in. And we do have complete exit or partial exit policy as far as it's part of our profit booking strategy. And I think fact sheet is already there, I think, on PMS Bazaar, but still just reproduced here for your easy reference of the kind of companies or the sectors we have exposure into. Our average holding period is 4 years. Our 3-year sales and PAT growth of our portfolio companies is in the range of 11% to 40%, as it says, and our exposure to top 5 sector is around 64%. And our average valuation of the companies is approximately 18 PE multiple. And so that's our return chart. So somebody who would have invested on 1 crore in 2011 would now have around, or is now having around 8 crore as of now in our portfolio accounts, part of this Care PMS G plus V strategy as we have. So yes, with that I end my presentation. Thank you so much, and we can take up questions if any.
Thanks, Amit. Thanks for taking us elaborative way of the presentation with more facts and insights, which our subscribers would not have heard frequently. So let me just jump into the question straight away. I want to structure it like this. See, for example, our growth G plus fund is a small cap fund, right? So now, before I get into the questions in the deeper, I would like to you to say a few words about whether the client should now invest into small caps, or is there an ideal time to invest now in small caps compared to the other opportunities available in the market, in the other market capitalization.
Right. See, I think so. We have never classified companies into small cap, mid cap, or large cap. It's a norm of the market that it classifies, or SEBI or the exchanges which classifies based on market cap. For us, it's a company, it's a business. If it's comfortable, if we believe it's likely to grow well, we will invest. So it's more of a stock specific approach. Second, to your point about whether we have a small cap strategy. So I would say it's not a you can I don't think I would like to call it a small cap strategy, but yeah, 70 to 75% of our exposure will be in small and mid cap space, and balance 20-25% will be in the large cap space as defined by the SEBI rules of the companies. Now coming to your core question about the investment in small cap, as I said, since we don't, stock specific opportunities are immense. We spoke about two sectors as also, and apart from it, there are a lot of companies which individually are doing really well. They are making capex, they are having their good financials, strong financials, and good growth. So I don't think there is a trend of small cap or large cap. Yes, if you had asked me this question probably 1 month back, there was a big fall because of FII exit, and large cap were probably more attractive at that point in time compared to small cap. But now I would not want to say that there is such sort of arbitrage opportunity available between that space. So I think opportunity do exist, and there is no a good time or bad time to invest in markets if your opportunity is good, the stock specific opportunity.
Okay, fine. Now we'll move on to the specific questions. Okay, among the top 5 to 6 funds in the segment, with a similar market cap style, I would say that CARE has got a very unique proposition in the top 5 holdings in sectors, of which definitely the paper industry. So you covered paper industry as well, on in terms of various factors that would help the industry to grow. The basic question is that now with all this digitalization happening, right? In terms of print media and such. So where do you see this paper industry, going forward?
Yeah. I think it's a very standard question. All our clients ask that, we are going paperless and you are investing in paper. So I think, as a country, we have to see that we are far behind the global curve. Which I showed in one of the slides also, that the 300 kg per capita consumption is what US having, but forget US, take China, that's having 65 kg and we are at 14 kg per capita consumption. Second is, our literacy rates are significantly lower, and when during the COVID period I was discussing with one of the portfolio companies in the paper business, there were hardly 5% schools, 5% schools who could actually go to online schooling. They did not have an option. So how much dependent we are on physical or the paper is reflected in that figure during that COVID period. So and you look at industry figures. So the writing and printing or the copier paper is growing by almost 6 to 7%, and packaging, which I spoke about, post COVID there was a huge surge. It's growing at double digit, 12 to 14%. So printing and packaging. When we talk about paper, it's not only writing and printing. The burger that you eat in McDonald's is wrapped in a paper, or a brown bag which is being given to you is also a paper. So paper has a very wide application, and with this environmental concerns, it's furthermore usage increasing. So I believe paper, despite the digitization which we are talking about, this industry still has a good time ahead with this packaging space growing significantly well, and all the companies which are in that space and good financials is likely to do well with integration, who are backward integrated. So I think paper industry still has a good time. Yes, we need to focus on this imports and import restriction as far as India is concerned. But yes, so far government is supporting, and I think domestic Indian companies are likely to have good time.
Thanks for sharing good point, Amit. With the perspective of packaging in the paper industry, I'm sure that this would have answered most of the questions come in the Q&A box of the paper industry as well. Let's move on to the next question. This question is not specific to the fund, but per se, when it comes to the portfolios across the PMS or industry, we see in the top 5 holdings, definitely BFSI would forming a part. So the question is not on that. The question is basically, with the listing getting increased on the insurance company space, on the asset management companies space, how do you see that the growth of the BFSI industry with these two sectors contribution? So this will help the investors to have a clear-cut idea about the BFSI, where normally they would perceive it as a banking and financial industry, but this insurance and the mutual fund industry would be a good contributor to the industry.
Definitely. Definitely. So the insurance and AMC space, so both as a business, I know without getting into company specific, as a business, they are likely to have immense penetration going forward because of a lot of awareness that is being created around equity markets or capital market exposure, or investing assets in other than the gold and FDs, which so far Indians have been more comfortable with, or real estate. So now that is increasing, and that's on asset management side, and same on the insurance side with Ayushman Bharat, this awareness about the health importance, etc., and medical bills, rising medical bills, that both businesses have a very strong potential to grow. However, for insurance, I'm not very sure because that field is becoming more and more competitive. I don't know, recently, if you know, 6 or 7 new companies have been licensed by IRDA. That itself shows there is a huge potential, but at the same time, the field is getting more competitive. So one has to really see at what pricing they are getting in, because the field becomes more competitive, it becomes difficult to make profitable. And on the AMC side, so far the number of players are very small. So yes, the potential of those small players capturing that big market is very good, and the opportunity definitely is very positive.
Thanks. There were also some questions on the automobile industry by the participants. So I'll just directly ask one question. See, with the entry of EVs, right, especially the two-wheelers and the four-wheelers are going to see a huge change. And especially the two-wheeler would see an immediate change in the overall sales trend. So where do you see that this transformation going to benefit the entire automobile space with the advent of EVs?
Yeah, so EV is a purely a structural trend. Everybody, that is the thing that will happen for the future. But still, it will take maybe 5 years or so to kind of, so to say, it will not even after 5 years, it will not even come close to where currently the IC space or vehicle is there. So there is definitely an opportunity. So all the companies which are taking aggressive steps, or they are tying up with the global players, or they are buying up startups in the EV space, they will capture on that opportunity. So I don't think one will have to look at only EV, because existing automobile player will not leave EV space. Like Maruti has been kind of avoiding that space for quite some time, had to finally come to the conclusion that no, I will have to be in that space. So nobody is going to avoid that space. So a player which is taking the aggressive steps in the EV space is something which one has to look at it. EV as in isolation, I am not very clear, because there's no like, so far there is no company like Tesla which is focusing only on electric vehicles, and so you play EV space. But automobile companies which are making aggressive steps in that direction is something which will be benefited in future, definitely, without doubt. They will eat away the market share of other players who are not, so to say, expanding in that space.
Okay. Let me also take a couple of questions from the participants. They've been waiting for a little long. So one, Mr. Vasudev Puranik, is asked a question on which sectors, existing sectors, have the potential to be disrupted going forward and form altogether new sector.
It's a very wide question.
I would actually interpret it this way. The question that you had answered previously on the EV's advent with the existing automobile, I think something similar to this is asking, is there any other industry where there will be a new change that will have a disruption on the existing industries as such?
I think as of now, the kind of industry classification or the sectoral classifications we have, I don't see that happening. There would be some small specific, like for example, in chemical, you have specialized chemical, agrochemical, multiple sub-segments. So there could be some sub-sector which could be disrupted. But what I have noted is the sizable players in that space always captures that opportunity. So if you are with the top 3-5 in that broad space, not in the sub-segment, they always capture by acquiring something, or by setting up their own space, etc. But at the moment I can't think of anything which is likely to significantly, existing business models are going to be disrupted. I think we have seen a lot of disruption in last 3 to 5 years with a lot of startups, etc. But I think something that we don't know as of now. So I would not like to probably answer, or will not be able to answer, so to say, that question.
Fair. I think Mr. Vasudev Puranik, I think we'll have to wait for much more clarity for the industry evolution to identify such alternates? So for now, that is the answer. So let us move on to the next question. The question is from Ketan. This question is very simple. What's your view for IT sector? Okay, but I would like to add a couple of data points on this. See, we have seen a drastic upside of the IT industry even in the last financial year. And I think invariably they contribute between 9 to 10% to the overall GDP of the country. And even in the exports, they have a majority contribution, I believe. So even what happened is in the current financial year, in the union budget 22-23, the allocation for IT and telecom sector stood at around 88,567 crores, 11.5 billion USD. While we are seeing sort of dullness prevailing in the the off late fall of the IT companies as such, we just want to know, are these union budget allocation is all being spent? We want to know, understand the overall the progress of it from you, Amit.
See, IT is going to be again a structural trend. It's not that it's a momentous. So what we saw during that COVID period, I think it just emphasized or pushed the lot of thinking caps of that we need to have or we need to be in this space. So we need to have some sort of infrastructure in place to ensure that we are capable to deliver it. So I think IT is a structural play. Second, with reference to this, what we saw last 2 years, a significant uptake and significant corresponding outperformance of the sector may not repeat, at least for short term, for the two reasons. One, there is a recessionary fears with this EU, UK, US, which is the largest market, are likely to be in recession. While we attend a lot of these quarterly con calls, the management commentary indicates that there is a bit of a delay in decision makings. So the pipelines or the orders or the contracts which are being discussed are being delayed a bit. So there is a bit of a US this recessionary fear which is there. And second, the kind of cost saved during last 1.5 2 years during the COVID period by work from home, traveling was not there. So there is significant savings did happen, and the margins of last year, I don't think they are repeatable, and I don't think anybody is expecting that also. But so it's likely to have some sort of an impact. One on the top line front, as I said about delayed decision making, and second on the bottom line because these all costs are back and will have impact on the margin. So probably near term, probably 2-3 quarters could be a bit subdued, but long term play, I think it's here to stay.
Okay, nice, thanks. I think this also answered Ms. Jayaja's question on the IT and banking. I mean, especially on the IT sector's overall industry forecast. And let me move on to the next question. Actually, see, of all these sectors that we discussed the last 1 hour's time period, most of them are very conversant with the audience. So one sector that where we require or the audience requires more clarity information is on the defense sector, and it's very stunning to see in the last couple of months, years, the sector has done tremendously well. And if I go into the deeper into the overall stock prices, even they have also replicated the same. So I would like to just request you to give a few words about how to overall understand the defense sector as such. Actually.
So per se, it's very simple because there are very limited, companies which are, so to say, authorized by the government, etc. So, and the order book is also in public. There is nothing that you don't know offhand. So I think I would say it's fairly easy. The reason defense sector in past has never done well is because of the PSU tag. So that PSU tag always, so to say, the valuation was always on discount of having PSU tag. But now, since last 2 years, the government has really been serious about the defense space. If you've been tracking politics, Rajnath Singh and Modi both used to significantly importance of the private sector play in this space. They want to make Atmanirbharta. So there is a really strong government push, and which is now reflected in the order book. So I don't have really handy data, but so these companies like BEL, HAL, BDL, and multiple other companies, their order books has almost there is a possibility of jumping to 3x from what they are today. So there is a strong play there in defense, and I think one has to go by the past executions has been decent, fairly decent. The financials of almost all the companies are very good. payout is very good, which is shareholder friendly. Now one has to look at the valuation, as you just spoke about the pricing part. There is a strong jump that has already come in for last 6 to 8 months in the defense space. So yes, one has to probably wait for some consolidation or take small bet with increasing their bet in that sector as the time pass and the conviction and the numbers are depicting the story of what we are currently identifying the sector trend as.
Okay. Thanks, Amit. And the next question is on the one of your top five holding metal sector. I also combined this with another question of the audience. Okay, so I'll go one by one. So post-COVID, the metal sector has good demand in India, but there are some supply side issues as well. In the meanwhile, the government had increased the export duty from 0 to 15%, right? So how do you see the overall sector growth going forward? This is on the metal sector. And would like to just combine one more audience's question on the fund per se. So he would like to know the approach of the fund. While we're talking about from sectors and then we're getting into the stocks, he wants to know the overall approach of your fund. Will it be a bottom up or a top down? Just for his clarification, I would like you to utter some words.
So on the metal sector or this, you spoke about the export duty, etc. So yes, there has been a structural shift. I mean, we've been, of course, there has been huge supply disruption that's happening. But one of the strong supply side impact, that's China, because China so far, the kind of capacity that it used to add on a year-on-year basis, they used to give this. Export promotion, export incentive of approximately 13%, which made that Chinese steel cheaper in the global market. And with this now environmental issues, they also have cut down on the production. So this supply side impact of this China factor is likely to be structural in nature, and the prices, although are now still down from the peak, I think around 25-35%. This steel sector, if I speak about. But they are likely to be far ahead of the pre-COVID levels. They are likely to be at the elevated levels, and that will clearly, so to say, improve the possibility of going forward. This demand-supply gap is likely to remain balanced, and therefore this fall or rise in prices is not going to be as erratic as it has been in the past. Second, the infrastructure spending, by government is a huge force or push, because so far public capex was one thing which was still on and it is still going on, but private capex was something which was kind of not there much in play, but that space is still there and it's likely to have a strong impact on the demand going forward. And the third, the last point about the export duty. So yes, it goes negative for the exporters. So for example, Tata Steel, it exports approximately 15% of their overall sales. So they are not likely to do well in that 15% of the space. So yes, that's negative. But on that front, I have view that it was done in the past, even in 2009 or so, where government had levied such kind of duty to avoid this, metal prices to go so high that, it impacted inflation numbers. So currently, I believe government wants to control that inflation number. And once that objective is achieved, this export duty will be removed. And that's, I think, the expectation of all the company as well, and that will bring back those lost opportunity of 15% as we spoke about. So overall, I think as a steel or a metal space, because of this China factor, there is a demand supply average with infrastructure push that is going to do well, and the kind of cash flows in last 2 years these companies have generated have cleaned up their balance sheet. Debts have significantly reduced, whether it's for Tata Steel or all other metal companies which were otherwise in the high debt situation. So that is now going to help them in making the future capex or having any sort of a disruption. They would be able to cater it far ahead. So there is a structural point there, so which is likely to do well. And second, on the whether the fund has the stock specific approach, or a sectoral play. So see, approach is always stock specific. As a portfolio manager, because ultimately, identification happens from the sector, but it's never that we start investment from the top. Yes, we of course we keep on reading papers, you keep on reading articles, you attend con calls, you have to see what sector is doing what. Like I showed you about the auto sector or the defense sector. There is a price action. So you observe many things, and then you come to a point, that okay, this stock is doing well, and there are some opportunity which are stock specific. So it has nothing to do with any sort of a sector, but that company for ABC reasons is doing well, or management is aggressive, or their growth plans are very strong, etc., etc., and they are doing exceedingly well. So approach, ultimately your money has to get invested in stock only. So it's a stock specific approach. But yes, so for example, I would want to say we did play sugar rally, we did play metal rally. For paper, I would say I don't think it's a paper rally. We believe that packaging business is grow, and JK Paper was the only player during this phase who expanded in the packaging space. So we thought that company will do very well. While there were other factors which were in favor of paper industry, but our approach was more on that. But yeah, as far as sugar is concerned, metal is concerned, it was more from the top-down or sectoral play, and for these companies it was more of a stock specific. So it's a mixed approach that we have, but primarily I would want to define ourselves as a stock specific approach. But yeah, you do play sectoral play when you get an opportunity. At the end of the day, everybody wants to make money.
Okay, I will move on to the next question, Amit. This question is on the fund per se. Okay, someone want to know overall portfolio turnover ratio of your fund and the overall buy and hold strategy. And this question also I want to combine it with, I think this question was asked by Mr. Ketan, and I want to combine this question with another question, which also raises concern on the portfolio returns for the last 5 years.
Sorry, I didn't understand the second part of the question.
It's basically on the funds return in the last 5 years.
Okay. See, in terms of, so coming to the first question, turnover ratio, I don't have the number handy, but I think if you looked at the fact sheet slide, which we just presented, our average holding period has been 4 years. So our turnover ratio is not very high, except for the COVID period. Yes, there was a lot of churning that did happen during that phase. But I will have to come back on the turnover ratio specific number. But our average holding period is 4 years, but it's not very fast as we have a long-term holding approach. The second point about the 5-year return. So yes, we are at 2022. So 18, 19 and a bit of 20, say to say. So were the worst year for the small and mid cap space. So our 75% exposure, as I said, is in small and mid cap space opportunity, and it saw a huge decline in terms of price fall during that 2 year. So while we did cover it up while in 2021 or 21-22 significantly, but the dent, whenever there is a fall of 25%, you have to cover 35% in order to make that loss of 25%. So to the dent that it had on 18 to 19 percentage fall, our return probably of 5 year is not looking that great, is what I believe would be the question of the participant, and that is the reason. But in any case, we did change a bit of strategy after 2018-19, where some bit of profit booking, some bit of sectoral weight restriction that we inculcated in our investment strategy, and that's now we don't believe that stage or that kind of fall we will see going forward.
Okay, thanks, Amit. The next question is on the fertilizer policy. So the Indian government is increasing its hold on the fertilizer sector with its One Nation, One Fertilizer policy. How do you see this policy decision affecting the fertilizer companies?
Oh, I think your participants, or you are very so to say active, I believe, because I think this is something which has come just yesterday. So I'm not sure whether I have the full knowledge, but broadly what I understand from this policy is, since government gives equal subsidy to everybody, whether it's a PSU or it's a private player, so probably they want to make it a brand Bharat on each fertilizer bag which is being sold to the farmers. So I don't think I have much information, but whatever I understand from the today newspaper article that I read, I think it would act as a discouragement to the players who have created their brand. For example, I know Chambal Fertilizer has a brand called Uttam. They have developed their so to say distribution network. They are creating farmer supporting programs. So all this they do to create their brand, or so to say to create their market in that particular state or city. So if all is going to come as a part of Bharat brand, then there won't be any incentive left for these players to so to say, do all these things. So on a financial front, I believe since everybody gets subsidy equal, I don't think it will have any impact. But yeah, it might have discouraged the players who are working on innovation or creating their brand by making this value-added thing, might get discouraged. But I think it's too early to say. I think probably more. I don't even have views of other fertilizer companies on this, so may not be fair for me to comment more than this.
Okay, fine. The question is on the overall fund. So the question is basically that how would you protect your fund with the climatic changes happening in the industry. And the second thing is that during times of volatile markets, what is the kind of risk management that we want to understand?
Yeah, so in terms of climatic conditions, of course, you have limited exposure to agriculture commodities per se. I think that is the first thing that any fund manager or a portfolio manager like us would do. In terms of where volatile times, etc. So it all depends on valuation. Okay, so volatile times comes at both times, in the bull times and bear times, both times. So for example, recently there was a huge jump in the valuation. So how much profit you book, what cash amount you keep for yourself. I don't know if you noted in one of the slides where we had shared about participation in various sectors, there was a one point about cash also. So we had say 0% cash in 2019, and now at this moment we are having approximately 8 to 10% of the cash in our portfolio. So that would allow us to play that volatile times. But it all depends on the valuation, as I said. So if we got an opportunity of valuation, we make a profit booking. You sit on cash to wait for that time that you will get good entry points, and you use that volatile times to use that cash in order to use that cash to grab that opportunity. So that is one thing which I believe can be done. But otherwise, volatility is part of the game. Anybody who is investing in equity has to accept it. If it doesn't, then it's I don't think it will have a good so to say experience flowing through the volatility of equity markets.
Okay, fine. I think this gave a fair idea and clear picture about how to overall understand the fund management strategy. And one last question actually, we run out of time. So this question is basically on the overall space, IT space. Where you are seeing a lot of fintechs, startups being coming in, especially the fintech space actually. So, definitely not all the fintech companies, can succeed. There will be some, failures, and some would succeed and come out. Not only, especially with fintechs, I'm generally talking about the startups. So they all would come to the IPO stage, right, gradually when they progress. So with this, advent, or when with this kind of more startups being started in our Indian market, where do you see that the IPO, going forward actually overall? So would these companies, overall succeed, and how is the probability of them coming up to the IPO stage levels? Any idea on that? Any input?
So I think at IPO stage, so we are talking about probably pre-IPO stage. So we are talking currently about capital markets or secondary markets, so to say. So that's one stage behind. So we are not participating in any venture capital or so to say unlisted space. But at the end of the day, everybody knows that in the unlisted space or in the venture capital space, it is the success ratio is extremely low. So the risk appetite a person who is investing has to be equally high to understand who understands that part. And in terms of startups reaching IPO stage, I don't think that IPO stage achievement. Reaching IPO stage should be considered as an achievement. I think ultimately one has to generate sustainable returns or cash flow in the business in order to make itself as an attractive, whether it's a startup or whether it's a leadership business. Ultimately, at the end of the day, as a businessman or as an investor, the cash flow generation or the profitability is what it matters. So I would not want to classify as an IPO as an achievement. At the end of the day, if it's making return and it's available at a reasonable valuation, we all know what valuations the startups get at the time of IPO. and which may or may not be sustainable depending on how they perform. But most likely, what we had seen in the recent past is a significant fall in the valuations. So when trading at 100 or those kind of multiples, they need to grow significantly their profits, which looks clearly not possible at this level. So you are actually entering. I'm not saying it's a good business or not. Maybe at a wrong valuation is something which I would want to say.
Okay. This question was basically asked from the overall IPO momentum perspective. So yeah, we got the answer. Thanks. We have come to the end, Amit. In fact, thank you for making yourself available for our subscribers and participants on the Friday webinar. And today's topic of overall understanding the sectoral trends for the wealth creation would definitely have given up good insights and idea to our participants. And we thank you so much, on behalf of People's Bazaar. And with that, we have come to the conclusion. And let me thank all the participants who have managed to log in today for the webinar. Hope you would have all found this session very useful.
Yeah, thank you, Umaji, for this, giving us Care PMS an opportunity to present this presentation to the participants or the subscribers to PMS Bazaar. And we hope that all the participants got some sort of value or some sort of understanding more about the sectoral trend. And if any questions which has remained unanswered because of time limitation, we are always there and accessible, and we can address those questions in the future. Thank you.